Hi, my name is Martin Connaghan. I'm one of the co-managers of Murray International Trust, along with my colleagues Bruce Stout and Samantha Fitzpatrick. Murray International Trust is a large global equity income trust, which was founded in Glasgow in 1907. And its investment objective is to deliver an above average dividend yield, which is currently about 4.6%, covered from the underlying securities, and then to grow that dividend and capital in real terms, so ahead of inflation over the longer term. In terms of the sort of current positioning, the trust is very well diversified, with the assets being split quite equally, actually, at around 25-26%. Between the three major geographic regions, being North America, Asia, and then Europe ex-UK. There's about 7% in emerging market debt securities, although we have been sort of taking that down. And there's about 12% in Latin America at the moment. That diversification sort of continues at the industry level. We have large absolute positions in technology at about 16%, communication services about 16%, financials, healthcare and consumer staples all making up significant portions of the trust. So there is a well-diversified picture to the trust at the moment. Performance in terms of the first 6 months of this year, fund performance has been okay. Total NAV return for the first 6 months was up 2.2%. Share price return was down 2.5%. And positive performers of that have been linked to semiconductor companies like BE Semiconductor in Holland, Broadcom in the United States, Taiwan's TSMC. So the semiconductor component to the portfolio has been a strong performer. Some of the Central and Latin American stocks like Doceo and Telefónica Brazil have been performing well. Stocks like Doceo, which is the owner and operator of Cancun Airport, have also been performing well. And then some European stocks such as Siemens and Danone have also been performing quite well. So positive performance has been coming from a number of different areas of the portfolio in terms of geography and business model. If you think of what the market move has looked like, at times this year, it has been quite narrow, and a lot of it has been driven by large US businesses like Nvidia and Microsoft, Tesla, Alphabet, Apple, Amazon. And we're just not exposed to those companies, not because there's anything wrong with those companies, but going back to that investment objective, taking active positions in those stocks, which make up about a collective 15% of most global indices, simply wouldn't deliver the investment objective. So performance in a relative context has been challenging, but as mentioned, that is not the investment objective of the trust. I think two European holdings that I would highlight to bring to life a little bit more. One would be Siemens, which is obviously the large global industrial, which focuses on areas of electrification and automation, digitalization. It's been simplifying its conglomerate business structure. It's been spinning off its energy business, its health and ears business, albeit it still holds stakes in both. And we like it because it is a business that makes everything from health imaging and diagnostic equipment to power distribution equipment. It's got a 3% dividend yield today. It's got consistent, low single-digit growth in that dividend over the last 5 years. And we just think that's a stock that will be a beneficiary of the global transition to being a ever more automated, connected and energy-efficient world. The other one I would highlight would be Enel, which is the Italian-listed utility, which has got significant exposures in Italy and Spain, where it operates power generation via both renewable and conventional means, and then the distribution and the supply of that power. So Enel is actually the largest distributor of, there's the largest listed renewable power developer in the world, with its capacity approaching about 60 gigawatts, I believe, across solar, wind and hydro. It pays a very attractive dividend at about 6.5%, with again attractive growth in that double-digit growth in that dividend over the last 5 years. We believe Enel and companies like Enel are going to be key in Europe, securing a less volatile, energy efficient energy environment via the energy transition and decarbonisation. The outlook at the moment, we're typically cautious about the world generally, particularly when we see global equity markets up 8-9% year to date in sterling terms. We've seen headline inflationary pressures ease, as base effects dragged the contribution of, fuel and food to inflation lower. But, there's the risk of potential for commodity shocks out there to pause that potentially. The oil price is back up at over $85. If energy supplies are to be tighter going forward, if Asia travel demand picks up, if the US economy remains resilient, could they reverse global disinflation? Perhaps not, but there is a real risk that it could perhaps delay the much anticipated easing cycle that everybody is looking at or looking for. Housing data in the UK, retail data in the UK remains challenging. China activity remains challenging. There's a lot of geopolitical tensions out there. We've got a US election on the horizon, which will be an unwelcome distraction, I'm sure. So there is a lot going on. And that being said, when we focus on the businesses from the bottom up, when we focus on income, it's a better picture and an easier picture, we believe. So you've got MSCI ACWI dividends. We're up 6% year on year in the second quarter, and about 80% of those businesses either maintained or increased their dividends. So given the difficult environment, that stability and that growth in income, given the investment objective, is a far prettier or far easier picture than the current environment for us. So thanks very much for taking the time to listen to the video. If anyone is needing any more information, please visit the Trust's website or use any of the links contained below within the website. Thank you.